China's households were hit hard by COVID-19. The restrictions put in place to stop the virus's spread, shocking both incomes and spending in Q1. Once COVID-19 was suppressed, however, the urgent action of authorities to restart manufacturing, construction and other services brought results for jobs as well as activity. Yet doubts still linger over the speed and strength of the recovery in consumption. While Chinese fixed asset investment has essentially regained COVID-19 related losses from the March quarter, retail sales over the first 7 months of 2020 are still 10% lower than the comparable period in 2019. There are two reasons this is the case. First, consumer spending is disadvantaged versus investment in this recovery because the shock from COVID-19 coincided with the Lunar New Year holidays, the time of year when consumption is at its peak and investment on hiatus. Second, while households did receive support through the crisis period, it was not of the scale seen in Australia or New Zealand. So, even though the shock from COVID-19 was brief, it is predictable that households need a period of time to heal their finances before consumption can fully recover. These two realities considered, Chinese household consumption to date in 2020 has actually done quite well. As has been the case in developed markets such as Australia and the United States, the recovery in retail spending in China has been concentrated in goods purchases, with food-related services hampered by social distancing. Online retailers of goods have been the clear winners, with year-to-date growth in e-commerce currently at 16% after having troughed at 3% early in the year. This is a stark contrast to total retail sales growth, which is recorded a low of minus 21% in Q1 and at July is still 10% down for the year. Clearly, these observations point to a capacity and willingness to spend amongst households, which, for a time, was held back by restrictions and fear. Considering the outlook, if we drill down deeper into the detail of the retail sales release, we further find that some of the weakest performing categories of spending year to date are housing related. This will turn, likely quickly, because housing sales and starts have rallied back strongly since COVID-19's activity nadir, and developer activity points to a strong pipeline of construction work to come. As household formation returns to normal and existing households upgrade their properties and lifestyles, demand for household goods will gain ground quickly. Wealth gains for owner-occupiers and investors should also support additional spending across a broad array of goods and, in time, services. With regards to spending on services, it is again worth emphasising that the outperformance of China in containing the virus will see services spending by its households internalised, particularly for tourism-related purchases. Whereas Chinese tourists were increasing their offshore spending year in, year out pre-COVID, these options have now been taken away. For a time, holidays will now be taken at home, and some of the savings likely spent on domestically produced goods. This shift will provide an immediate benefit to GDP through reduced imports, but more importantly will help develop new capacity in China's economy and keep income and wealth within its borders. Despite questions being raised over its strength, the recovery in household consumption is therefore best considered robust and the outlook strong. We'll see you next week.